Okay, folks, I hope you're able to hear me now. We've been able to try come up with a fix for the sound issue. If you are able to hear me, I'd really appreciate it if you could just indicate that in the live chat area. I've got my technical guy also on standby just to confirm that it is functioning well. So apologies for that stop start. So folks, let's get on with our webinar. So where we are effectively is today we're discussing the IFRS 9 requirements for hedge accounting. And IFRS 9, as you know, is the standard that replaces IAS 39, and it is effective for financial periods that are commencing from the 1st of January 2018 or after. And the long and short of what we'll be discussing today is we'll be building on the principles that you already are familiar with from IAS 39. So we'll have a little bit of a recap because those principles remain intact under IFRS 9. And then we're going to talk about some of the things that are different under the new standard. So if we can, we're going to just start off with discussing what exactly is hedge accounting. So hedging itself is really an economic activity that the business engages in because as you undertake business, you are exposed to different financial risks. And these are normal business risks that arise. So these risks could be from changes in exchange rates, changes in interest rates, equity price changes, commodity price changes, etc. Just the very nature of being in business means that you're likely to be exposed to some sort of financial risks. Now, an entity could do several things as a result. It could, for instance, decide that it is going to accept these risks and therefore not concern itself with mitigating any risks and leave it itself naked to all of the volatility, or it could engage in activities to mitigate those risks. And we call that risk mitigation behavior hedging. Typically, hedging involves the use of derivative instruments, but it doesn't have to. And part of what we'll discuss a little bit later is the different ways in which IFRS 9 allows you to acknowledge ways in which you are potentially hedging yourself against risks without necessarily engaging in exposure to derivative instruments, which is something of a difference from what we experienced from IAS 39, which tended to restrict hedging instruments to derivative instruments except in very, very narrow circumstances. So if we know what hedging is all about, then the question must be, well, why do we need special rules for hedge accounting? So surely if you engage in hedging, the accounting should pick that up automatically. Well, we have a challenge with this because the way that IFRS treats hedging is that without applying the hedge accounting rules, it treats the hedged item as being a completely unrelated exposure and transaction to the hedging instrument. So for instance, if you were hedging a forecast purchase of certain inventory in a foreign currency, and you went to the bank and you purchased a foreign currency option, IFRS at the base level would treat the commitment to purchase inventory as being completely separate to the fact that you've gone and purchased a foreign currency option. So those two things would not be accounted for as if they're related in any way. Whereas from a business perspective, those two things are very tightly related. And in fact, you wouldn't have done one if you hadn't done the other. So what hedge accounting does is that it sets about the accounting framework, which would then allow you to mimic as closely as possible what you're trying to achieve from a risk management perspective. And really all it does is sets around an administrative framework and a set of accounting rules that allows you to achieve that outcome. And that's really what we call hedge accounting. We'll discuss in a moment the different types of hedging that you can have. But if you didn't have hedge accounting, you would certainly be exposed to volatility in your income statement, either resulting from the different ways in which you could measure gains or losses on your hedged item and your hedging instrument, or because the timing of gains or losses between those items would also be different, or lastly, could simply be that the presentation of your results would indicate volatility because it would have the gain on the hedged item, for instance, sitting in one place and the loss on the hedging instrument sitting in a different place. Was actually what we should be looking at is the net position of the hedged item and the hedging instrument. So let's get a couple of things straight in terms of the definition. So what is a hedged item? Hedged item could be an asset, a liability, firm commitment, highly probable forecast transaction, or a net investment in a foreign operation. So this is a wide variety of things that could be the hedged item. And the hedged item, in short, is what is that thing that gives rise to the financial risk that we're now exposed to? So specifically for hedge accounting purposes, it's one of those items that exposes the entity to the risks of changes in fair value or changes in future cash flows, and is designated as a hedged item in a hedge accounting relationship. So that's our definition for a hedged item. In terms of a hedging instruments, and we'll come back a little bit later in a bit more detail with respect to both of these items. But a hedging instrument includes any derivative with an external party or a non-derivative financial asset or financial liability. And under the IAS 39 rules, that only applies with respect to a non-derivative for a hedge of a foreign currency risk. You'll see later on when you talk about IFRS 9 that this is one of the areas which has changed. And it excludes things like written options and options over your own equity instruments. So with that said, in terms of hedge documentation that an entity needs to have, and again, just to remind you, this is largely a recap of what you should already be aware of in terms of IAS 39. You need a documentation of your hedge, which means you need to document what exactly is it that you're hedging. So what is the transaction or the asset or the liability or the firm commitment? What hedging instrument are you using to hedge the particular item? What is exactly the nature of the risk that you're hedging? Is it a foreign currency risk? Is it an interest rate risk, etc.? What is your risk management objective? So what are you trying to get? So obviously, at an overall level, what you're trying to do is to reduce volatility, but more specifically, what is it exactly that you're trying to achieve in terms of your risk management strategy? And then finally, what method are you going to use to be able to determine the effectiveness of the hedge that you have created? So you'll see a little bit later in this presentation that I'll come back to updated elements that speak to both the, so not just both, all of the hedged item, what are the hedging instruments, and what do we need to have in our hedge documentation. What we have currently discussed is what are the primary requirements in terms of IAS 39. So you should have a clear ability to then contrast what are the new requirements versus what is currently the case. So effectively, we have three types of hedges. We still have three types of hedges. So you have your fair value hedge, which is a hedge of exposure to changes in the fair value that are attributable to a specific risk, and which, if those risks occurred, could impact profit or loss. A cash flow hedge is a hedge to exposure of variability in cash flows attributable to specific risk, and which could also affect profit or loss. And then finally, net investment in a foreign operation hedge effectively says it's a hedging instrument. If a hedging instrument is designated as a hedge of a reporting entity's interest in the net assets of a foreign operation, the gain or loss on the effective portion is recognized in other comprehensive income rather than the standard treatment, which would be to recognize it in profit or loss. And we'll discuss each of these with a small or a brief example just to make sure that we're all on the same page as to what are these three different types of hedges. So let's kick off then with a fair value hedge. So in our example, we've got a company, South Point Limited, which is a fixed rate loan receivable. Its concern, or what we would term the risk, is that if market interest rates fluctuate, which is represented by that green line on the slide, over the duration of the loan, the fair value of the loan will be affected. So if you have a fixed rate loan and market interest rates go up, generally speaking, you'd expect the fair value of the loan to go down because its interest rate has not changed relative to market conditions, so it's a less attractive instrument compared to instruments that are now paying at the enhanced market rate on a relative basis. And the same would apply that if market interest rates drop, then you'd expect the fair value of your fixed rate instrument to go up because obviously it's not impacted by the drop in returns and therefore becomes a more attractive asset under those conditions. So if this is a loan in terms of which it exposes you to these fair value or potential fair value fluctuations, and that is a concern for you, in other words, a risk that you're looking to mitigate, then you could enter, for example, into an interest rate swap. In terms of an interest rate swap, you would then exchange the fixed interest, which is what you're entitled to under the existing contract, and you could swap that for a floating rate. So you would go to a bank and say, I'm entitled to receive 5% fixed interest over the next 5 years. What is the pricing that you would give me on a floating rate over the same duration? And they might give you a floating rate in exchange for your fixed rate. Obviously, you'd need to probably pay a premium to enter into the swap, but effectively, you now become exposed to the market rate from the bank, and you still receive your fixed rate from the counterparty on the original loan. So in this way, you've effectively swapped out your fixed interest rate for a market interest rate, and by doing so, you've protected the fair value of the loan and thereby mitigated the risk that you're concerned with. So this would be an example of a fair value hedge. Okay, so in terms of the accounting that one would apply to a fair value hedge, you would take the changes in the fair value of the loan and recognize that in profit or loss. And then you'd also take the changes in the fair value of your swap and recognize that in profit or loss, offsetting the two. So you only really are showing the net position. And to the extent that one item is changed more or less than the other, that'll give rise to ineffectiveness. In other words, they're not a perfect match for each other. They're not completely offsetting each other one for one, which is quite normal in the marketplace. Then the excess portion would then be reflected as a hedge ineffectiveness. So in short, then, that is what we would represent. This is how we would account for a fair value hedge. If we turn to a cash flow hedge, in this example, we have a company, North Point Limited, has a loan receivable that attracts interest at a market rate. So this one has got a floating rate in terms of its contractual terms. Now, if you have a floating rate, the concern that it might have is that as market interest rates fluctuate, the amount of cash that it is going to receive in the form of interest income is going to be at risk because it could fluctuate as market interest rates change over time. So this is the risk that they wish to mitigate. They could also enter into an interest rate swap, except in this case, they are swapping out a market interest rate for a fixed interest rate. So now that gives them absolute certainty as to what amount of interest that they'll receive over the duration of this loan, and thereby they would have mitigated or hedged the risk that they're concerned about. So the accounting for a cash flow hedge is a little bit different in terms of how it's treated to a fair value hedge. So in effect, what we would do is we would take the interest rate swap, which is a hedging instrument, and the fair value would be deferred in equity through OCI, and then we'll take the change in the hedged item, and that change in the hedged item would go to P&L. Now that's not the end of the process. What we then do is determine to what extent this hedge has been effective. And to the extent that the hedge has been effective, the amount that has been taken to OCI is then recycled to P&L in order to offset any changes in the hedged item that have been recognized in P&L. So in other words, it is recycled in such a manner as to match the underlying transaction. So that in our example, the loan now looks, for all intents and purposes, as if it is a fixed rate loan, rather than being two separate transactions where you've got fixed rate income and you're paying out a market rate. So it tries to mimic the same income profile that you would get if the loan had originally been set out as a fixed rate loan. So in this case, you've mitigated your risk, and you're also presenting your financials in a way that represents what you have been able to achieve through the use of a hedge. In terms of the third type of hedge, which is the net investment hedge, in our example that we have here, we have a company, Compass PLC, which is a United Kingdom sterling-based company in terms of its functional currency, and it has a subsidiary which is in the US, which has a US dollar functional currency. So before we go any further, if we just take that as is, at the end of each financial period, in order to consolidate its US subsidiary, Compass PLC would be required to convert the income statement and balance sheet of its US subsidiary into pounds, and as a result, that would give rise to some exchange gain or losses. And in terms of IAS 21, those gains or losses would be recognized in other comprehensive income and would be accumulated in equity as your foreign currency translation reserves. So that would be the default treatment of just that part of the scenario. Let's add to that scenario the fact that Compass PLC has borrowed from a US bank $50 million, which may have nothing to do with its US subsidiary or something to do with it. It really doesn't make any difference. But it has exposed itself to a $50 million liability. Now, again, if we just take that liability and how it ought to be accounted for, at the end of each period, because it is a foreign currency denominated monetary item in terms of IAS 21, you would need to convert that loan into pound sterling, and any translation gains or losses would be recognized in profit or loss. Now, if you are part of the management of Compass PLC, you would be saying, on the one hand, we have a US dollar asset in the form of our subsidiary, which generates US dollar outflows, and we have a US dollar liability where we have to settle in dollars. So when I'm looking at my currency risk, I could make the argument that, strictly speaking, I'm only really exposed to a net 20 million US dollar net asset, and I've hedged by borrowing in dollars 50 million of that net asset. So in order to try and give some accounting representation to that fact, if Compass PLC is to designate that loan of $50 million as a hedge of its net investment in its US subsidiary, instead of taking the gains or losses on that loan to profit and loss, which is what it would be required to, by designating it as a net investment hedge, it would take the gains or losses on that loan through to OCI as well. A lot of companies make use of this strategy in order to reduce profit or loss volatility, where they have foreign currency exposure which is mitigated by foreign operations that operate in countries where the functional currency is the same as the liability exposure. So if you look at this next slide, it effectively shows you that instead of the gains or losses on that loan going through to income statement, it goes through to equity via other comprehensive income. Okay, so we've covered the three main types of hedges. So you'd all be familiar with these three types of hedges from IAS 39. And now we really want to focus our attention on what's changed. What are the main items that have really changed in the standard? So as a preamble and just really as a headline to why have things changed, the primary criticism of hedge accounting under IAS 39 has been that it is far too rules oriented. So it set up a very narrow set of rules, and if you just missed something by a small margin, you would not be able to apply hedge accounting, whereas from an economic point of view, the business might well in fact be hedged, and therefore you would lose the opportunity to apply hedge accounting because of the strict rules that apply to it. The other criticism is that the reality of risk management is that it is dynamic, which means that market conditions are constantly changing, and a business is constantly re-evaluating whether its current risk practices and objectives and its strategies are still going to be effective under the current market conditions, which may have changed from when they originally set out their strategy and their objectives. And the way the accounting rules worked, it's almost as if a company had to be able to predict with relative perfection what future market conditions were going to be. Whereas in fact, risk management is about your ability to respond to changes rather than to forecast what those changes will be. So I felt that the accounting really needed to follow the much more dynamic and flexible approach of risk management rather than to have a very rigid framework around which risk hedge accounting would be permitted. This obviously requires that there is more room for judgment to be permitted rather than having strict boundaries. So you'll see that when we discuss some of the changes in a bit more detail in the following slides, you'll see elements of that coming through. And then also another criticism was that there was a very narrow definition of what could be considered hedged items and similarly what would be considered hedging instruments. So all of these different areas have been addressed in terms of the changes that are now coming through under IFRS 9 in terms of hedging requirements. Okay, so let's just start off then with changes that impact hedged items. So for instance, IFRS 9 now permits hedge accounting to be applied to aggregated exposure. And I'll try to explain this through the example that we have. So let's take this example. You have a platinum mining company which may firstly wish to hedge the future price of platinum. So it's mining platinum, that's going to be the output of its production, and then it's going to sell that platinum many, many months later. And it is concerned that between now and then the price of platinum may drop, and therefore it wishes to hedge that risk, which would be, in this case, a commodity price risk. And it decides it is going to mitigate this by entering into a forward contract for the price of platinum. It happens to be a US-based company, so it enters into a forward contract price of platinum. Now, there's no problem with this. It could easily be designated as a hedge accounting relationship because you've got an instrument that mitigates the primary risk that has been identified. At a future date, management could still then be reassessing the risk environment, and it determines that there is a further risk, that not only is it worried about the platinum price, which is denominated in dollars, since this company is, let's say, based in South Africa, and it's exposed to the South African rand, which we've called ZAR in our example, it now also wants to make sure that it also fixes the exchange rate between the ZAR and dollars. So let's just think about this scenario. The first risk is that the price of platinum in dollars is going to change over time. And it sorts this out by fixing the future dollar price of platinum. The second risk is that when it sells that platinum at whatever the fixed price now is, it then translates those cash flows into ZAR, which is its functional currency because it's South African based. And It is now exposed to the risk that the dollar and ZAR exchange rate could have done some strange things in the intervening period, and therefore it also now wants to fix the ZAR dollar exchange rate in order to mitigate that second risk. So now what is permitted under IFRS 9 is you could take the first hedging pair, which is your future sales transaction, together with this hedging instrument, which is the future platinum price that you fixed, and you could take that pair and treat it as a hedged item for the second hedge, where you now have your ZAR dollar forward or FX option, which is fixing the exchange rate between South African rand and the US dollar. Under IAS 39, you would not be permitted to do that. You could not include in the hedged item a hedging instrument. But IFRS 9 allows us to include this pair, which includes a hedging instrument from the initial hedge as the hedged item. So it gives a lot more flexibility and is much more consistent with what risk managers actually do on the ground, and therefore should result in a closer alignment in the way that hedge counting is done compared to what the risk practices on the ground actually are. So that's quite a big change for entities that are affected by these type of circumstances. The second change that impacts hedged items is the hedging of risk components, specifically related to non-financial items. So those of you that are familiar with IAS 39 would say, well, that's always been permitted, but you would also know that that's only been permitted for a foreign currency risk. So now what has been expanded in IFRS 9 is that we can include the risk component of non-financial items that are not related to currency. So that could be related to commodity price, for instance, rather than currency. So that's now permitted. So it's expanded the risk categories that can be hedged in relation to non-financial items. So the example that I've used to illustrate this is, let's say, for example, a soft drink manufacturer that wishes to hedge against the future price of aluminium, which is the key raw material in the cans. And it can now elect to designate the aluminium component of the can as the hedged item rather than designating the entire can as the hedged item. So you might say, well, what's the difference? So if you look at the eventual selling price of a can of aluminium, is that it could be, for instance, 70% the price of aluminium plus 30% things like conversion costs, labor, machinery, etc., that are added on to the price of aluminium to arrive at a final price. Now, because all of these other components are not related to the price of aluminium directly, if you wanted to hedge the entire can, you would go into the market and you could only effectively hedge the aluminium component. So if you then hedge the aluminium component in the derivative, but in the actual hedged item, which is the can, you've got 30% of other things that are not related to the price of aluminium, that can give rise to hedge ineffectiveness. And especially under the rules of IAS 39, that would have kicked you out of hedge accounting altogether. But even under the rules of IFRS 9, it may distort the perceived effectiveness of your hedge. By being able to designate the aluminium component of the can as being your hedged item, and then having a very correlated instrument in terms of a aluminium future that you could designate as a hedging instrument, you're much more likely to have hedge effectiveness in that type of relationship. So being able to designate risk components for non-financial items is going to open up the space for a lot more hedge accounting than what is currently the case under IAS 39. A third example of expansion is the hedging of groups of gross positions. So this shouldn't be confused for macro hedging. So as you know, under IAS 39, there are already some requirements for macro hedging. IFRS 9 hasn't yet finalized its requirements for macro hedge accounting. It's subject to a separate project, which is still ongoing. And once that project is complete, then those requirements will be incorporated in the new IFRS 9. So as things stand, companies that are using macro hedging under IAS 39 have the option to continue to apply macro hedging using IAS 39, even as they apply IFRS 9 for everything else. Alternatively, they can then use the hedging of group of gross positions, which is not quite 100% correlated to macro hedging, because it can only really be applied to closed portfolios rather than open portfolios. So therefore, that's just something for you to be aware of if you are in this space. Further changes in terms of items that can be designated as hedged items. So hedging of net positions also now permitted. And I guess the best way to illustrate what we're talking about here is by use of an example. So the example that we have is that you've got a US dollar functional currency entity, which has got purchase requirements of 200 million euros worth of inventories and have sales, committed sales or forecast sales of 170 million over the coming period. So both of those, commitment to purchase inventory and forecast sales, would qualify as hedged items in their own respect. It then looks at the circumstance and says, well, strictly speaking, I only have a net exposure of 30 million euros if I take into account that 170 million of my expected purchases of inventory is already offset by my 170 million expected sales. So therefore, the net position that I really have an exposure to is the 30 million euros, which is a net exposure in terms of having to purchase euros over time. So therefore, the entity says, I want to go and hedge my net exposure. Under IAS 39, you were not permitted to hedge net exposures. The way that they would have had to account for this is that they would have had to say, well, yes, my effective net exposure is 30 million, so this is what the risk management position would be, but they would have to almost misrepresent that position by saying, well, I'm now going to say that I've hedged 30 million of my inventories, and I have not hedged the remaining 170 million, nor have I hedged the 170 million in sales, because those two, I'm going to say, have a natural offset, and I haven't hedged them. The reality is I didn't decide not to hedge 170 million. I decided to hedge the net exposure of 30 million. So what the new accounting requirement in IFRS 9 allows you to do is to have a better and more accurate reflection of what you're doing from a risk management point of view, which is to actually hedge your net exposure rather than to have this kind of contrived 30 million exposure for just your inventory purchases. So it should also lead to closer alignment of risk practices to hedge accounting requirements. The next item is hedging of layers of an item or a group of items. So again, all of these things are reflective of what is happening in risk management practices themselves, and we're simply accommodating how the accounting, hedge accounting, is better aligned to that. So again, to illustrate what we mean by this is, for instance, a company wants to hedge, uh, 10 barrels of, it's got an exposure, beg your pardon, to 100 barrels of oil in a particular transaction, and it decides that, well, I want to simply hedge the first 10 barrels of that 100 barrel transaction. It is now allowed to do that. So this is slightly different from components of risk, because a component of risk will talk about, I'm looking at the aluminium price, for instance, whereas a layer of risk takes all of the risks that are sitting within the 10 barrel, that are sitting within the 100 barrels, but limits the hedged item to 10 barrels, as opposed to saying you're only hedging the let's call it the crude oil price of the 100 barrels that you're looking at. So components and layers they seem similar at face value, but they're a little bit different once you get into the detail of it. So this was permitted to a degree under IAS 39, but it is much more open in terms of your opportunities to hedge layers of a group of items than it was under the old IAS 39 standard. The last item we'll talk about is hedging of equity investments that are measured at fair value through OCI. So if you recall from the classification and measurement webinar that we did on IFRS 9, you'll know that there are a number of different categories that apply. And one of those categories applies specifically to equity investments. And if you have an equity investment, IFRS 9 permits you to designate that equity investment at fair value to other comprehensive income at initial recognition. Now, at face value, that looks very similar to available for sale, but there is a key difference. Under available for sale, when you eventually dispose of that instrument, the deferred gains or losses in equity would then recycle into profit or loss. Under this designation in IFRS 9, there is no recycling that happens through profit or loss. Now, that doesn't mean that these instruments aren't open to risk. These instruments are as open to risk as any other equity instrument, so they're exposed to equity price risk. So a company could decide that it's invested in, let's call them shares in Apple, and it wishes to mitigate the possibility that those shares might drop in value and enters into a put option. It could now designate the put option as a hedging instrument against an equity instrument that is carried at fair value to other comprehensive income. And the effect of that is that the fair value of the hedging instrument, instead of going through profit or loss, will now also follow the fair value movement of the hedged item and be recognized in other comprehensive income. So I guess this is not really revolutionary in the sense that if you create a new classification category, you need to try and accommodate how do you account for the hedges that are associated with items that are classified in that category. And that's what this change effectively relates to. So not only have there been changes to the different types of items that we can designate as hedged items under the new standard, but also there's been an expansion of the hedging items that can be designated as hedging instruments under the new standard. So for example, non-derivative financial instruments can now also be designated as hedging instruments for risks that are other than foreign currency risk, which is what it was limited to under IAS 39. So just to be clear, you can certainly designate them for foreign currency risk, plus any other type of risk that might be sitting in that instrument. So it's not limited to foreign currency risks that are sitting in those non-derivative financial instruments. You can also designate embedded derivatives. That's been present on IAS 39, but it's also expanded the circumstances under which that happens. And bear in mind there are some changes because under IFRS 9, the embedded derivatives are not separated out from financial assets, but are carried as part of the whole asset. So the way that you do your hedge documentation and setting up of the hedging relationship is also going to be somewhat different. The way that we treat changes in the time value of an option. So under IAS 39, the default treatment would be that that would go through profit or loss. There are now circumstances under IFRS 9 where the time value element of an option is then treated as part of the hedging cost and is deferred in other comprehensive income and then recycled back into P&L on a systematic basis or whenever the hedged item affects profit or loss. And the same thing would apply in terms of currency basis spreads. It will also be deferred in other comprehensive income and then recycled to P&L as and when the underlying transaction affects profitability. So some of these, especially those last two changes, are quite important changes which improve the effectiveness of hedges over time in terms of how they are reported compared to how it was done under IAS 39. We discussed hedge documentation early up when I was sort of recapping on IAS 39 requirements. And it's remained largely the same as it was before, although I guess one probably needs to consider that there are other new elements. So the key new element that's here is really on the last bullet. So we've always had to document what our hedge effectiveness, how we were going to measure hedge effectiveness for a given hedging relationship. But we now also have to document something called the hedge ratio. And we'll discuss that in the coming slides as to what it is and how you determine it and how it can change over time. So at the basis of the requirements for hedge accounting in IFRS 9 is now a very explicit requirement that there must be an economic relationship between the hedged item and the hedging instrument that's being used to mitigate the risk that's been identified. And I guess really, if you apply IAS 39 properly, you possibly would have really come to that same conclusion without having it being mentioned explicitly in the new standard. However, by mentioning this explicitly in the new standard, it does open up the opportunity to use what we would call proxy hedges. So what's an example of a proxy hedge? So let's say, for example, you wish to hedge the commodity price for a commodity X. But commodity X doesn't have any derivatives in the marketplace that are traded for commodity X. So you can't get a derivative that's going to be exactly on commodity X that we use. And so let's, instead of calling it commodity X, let's call it coffee beans. And if the commodity is coffee beans, we know that there are different grades of coffee bean. And it may well be that you're only going to get grade A, the one that is being traded in the marketplace as a derivative, whereas actually the hedged item could be that you're going to produce grade A, B, or C, or D type of coffee beans, which would attract different prices. So let's just say, for example, that your expectation is that you're going to produce grade B coffee beans, but you can only hedge in the marketplace grade A coffee beans. What you would need to show is that there is still a correlation between the price of grade A and B coffee beans over time, which even though you would have preferred to use grade B coffee bean derivative, because it doesn't exist and you can only hedge with grade A, it is still going to give you an effective hedging relationship because grade A is a good proxy for grade B. And we'll talk about how you correct for the differences when we discuss the hedge ratio in a minute. But this is an example of where you don't have to use the exact item that replicates the underlying risk in order to show that there's an economic relationship. So it opens up the potential relationships that you can designate as hedging relationships in terms of this new standard. However, it's important that you can't just choose random relationships because it's unlikely that you'll be able to show that they're likely to be effective. And if you can't show that, then the accounting standard doesn't permit you to designate them as being in a hedging relationship. The last consideration, which is again not really that different from IAS 39, but it's worth reiterating, is that because you're hedging a given risk, which is commodity price risk or interest rate risk, etc. And typically these contracts are always with an external party. So if it is on the hedged item, it is your contract to sell the coffee beans to party B, for example. So that means there is embedded in that transaction, there is credit risk on whether or not party B can pay you. And on the other hand, you enter into a derivative to cover that transaction with another party, likely a bank. So embedded in that transaction is either your own credit risk or the credit risk of the bank. So credit risk sits differently on the hedged item and the hedging instrument. So what you don't want is to have credit risk be a dominant factor in the fair value of either of those items, because if it is, it's now going to mute the effect of the actual risk which we're trying to mitigate, which is the price of coffee beans. So if the price of coffee beans is dominated by the credit risk of the counterparty in the transaction, then it's unlikely to be an effective hedge. So IFRS 9 says we need to ensure that credit risk is not a dominant factor in the changes in the fair value of the hedged item and the hedging instrument that we observe over time. And again, as I said to you, in terms of IAS 39, I would expect that most people would have arrived at that conclusion, but it is explicitly set out in this standard. So if we turn to hedge effectiveness, there's quite important changes in this space. So from a hedge effectiveness point of view, IFRS 9 only requires prospective hedge effectiveness assessments for the purpose of determining whether or not a hedging relationship still exists and exists in a manner that is consistent with the original risk management objective that was set out when that hedging relationship was documented. Under IAS 39, there was a requirement to do both prospective assessments as well as retrospective assessments. And strictly speaking, retrospective assessments effectively meant that you needed to do a quantitative assessment for the retrospective portion. So IFRS 9 takes that away and says the only thing we're concerned about in terms of risk is what's going to happen from now going forward, and we don't look backwards. And that's just to assess whether or not the relationship that we've documented and designated is expected in the future, because it's still playing out, is expected to be effective, because that's really what we are most concerned about in terms of a hedging relationship. Is it effective or is it not? Now, in terms of doing that assessment of whether or not it is effective, you can either do it qualitatively or you can do it quantitatively. So in terms of a qualitative assessment, you might do something which we refer to as critical terms matching. So on the one hand, if I'm my underlying hedged item that I'm hedging is I'm hedging a forecast sale of 100 tons of coffee beans to a customer in 3 months' time, and it is grade A coffee beans. And on the other hand, my derivative is going to be settled in 3 months' time, and it is also derivative for grade A coffee beans. Then and I'm also matching the extent, so my sale is for 100 million, and my derivative has a nominal value of 100 million, then all of the critical terms are matched. It's the same commodity, it's the same nominal amount, it's the same duration. There are obviously differences in counterparties, but remember we said we expect that credit risk can't be a major dominant factor in the changes in fair value, so that shouldn't be a factor. So if we've matched the critical terms of the hedged item and the hedging instrument just on a qualitative basis by assessing that, we can say, well, we expect that this hedge is going to be effective, and that it may well be sufficient in terms of proving that you have an effective hedge relationship. When you have slightly more complicated hedging relationships, so you'll recall we were discussing the expansion in the hedged items that, to which you can apply hedge accounting. You can apply to a layer, you can apply to a risk component, to a net position, to groups of positions, etc. That becomes much more difficult to prove on a pure qualitative basis because the critical terms are numerous, there are many, they're potentially in a macro hedge constantly changing. So to do a qualitative assessment isn't really going to be sufficient. You're going to have to design a quantitative assessment of how you're going to show that you expect the hedge to be effective. And the standard doesn't set out any one methodology that you need to apply to determine a quantitative effective hedge. And this is where the folks that are involved in risk management, in order for them to decide on a strategy, they need to know whether or not their strategy is working. And in order for them to test that, they must have come up with a way in which they would test effectiveness. So rather than looking at it as an accounting exercise in order to comply with IFRS 9, the real question needs to be, well, how do the risk management function know that the strategy that they're employing is going to work? They must have a way of measuring it. And what you do is you take that test and you apply the elements of that test in order to demonstrate and document for IFRS 9 what the expected effectiveness of the relationship will be. And if that test shows that it's expected to be effective, then you're fine. If not, then you really need to question the risk management rather than be concerned about whether the accounting is what you would prefer or not prefer. So with that having been said, if we then turn to the third bullet on that slide, under IAS 39, if you are applying a quantitative test, the standards set out a boundary within which effectiveness needed to come out in order for the assessment to be positive for effectiveness. And that came out, and that boundary was the 80% to 125% range. So if you didn't get hedge effectiveness that came out in that range, it automatically was concluded that it was not an effective hedging relationship, and therefore you could not apply hedge accounting at all. Under the new standard, there is no bright line of 80 to 125%. So when you set out your hedging relationship at inception, and you set out what your expected effectiveness is going to be, first of all, you need to assess whether or not that meets your risk management objectives. And if it does, then that effectively becomes the benchmark against which we are measuring it. So that means you can tolerate a reasonable amount of variability outside of that expected effectiveness. But once it gets broader than that, then you have to surely assess it on a judgment basis as being potentially ineffective, and then have to discontinue hedge accounting where that arises. So remember, we spoke about one of the key changes being the expanded use of judgment in IFRS 9. Well, this is an example of where there's going to be an expanded use of judgment. And whenever there is an expanded use of judgment, you can anticipate that there will be the potential for disagreements between, for example, companies and their auditors, and therefore you'll need to engage actively to try and make sure that you're all on the same page with respect to how you're going to determine effectiveness where it is determined on a quantitative basis. No matter what you do in terms of designing a hedge, there's always going to be hedge ineffectiveness, which is really the difference between the response of the hedged item in terms of the change in its fair value and the response of the hedging instrument in terms of its compensating change in fair value to mitigate the risk concerned. Then hardly ever in the real world going to match each other out perfectly. So there's always going to be an element of hedge ineffectiveness. Now, to the extent that the hedges are ineffective, in other words, not perfectly correlated, the element of ineffectiveness, i.e. the extent of over or under compensation, is recognized in profit or loss. This is not the same thing as assessing whether the overall hedge relationship is effective. That assessment is what determines whether you carry on with the hedge accounting or not. The ineffectiveness result, which is just a matter of fact, change on the hedging instrument was 10, change on the hedged item was 8. Yes, we can say the relationship is effective because he had a good correlation, but there's a difference of 2, and that 2 is the ineffective portion, and therefore should be recognized in profit or loss. So I am paraphrasing a little bit in terms of the example that I've just given you, and you should note that there are slight differences in terms of how we actually determine quantitatively the amount of ineffectiveness to be recognized in profit or loss between a fair value hedge and a cash flow hedge. But that is the same as it's always been under IAS 39 in terms of the ineffective portion that is recognized in profit or loss. We spoke about hedge ratio in my first slide when I was highlighting, my first slide on hedge documentation under IFRS 9 was highlighting differences with IAS 39. And effectively, what a hedge ratio is, and it actually builds on the last point that I made on the previous slide. Effectively, what a hedge ratio represents is the relationship between the quantity of the hedging instrument and the quantity of the hedged item in their relative weighting. So if I go back to my coffee bean example, so I have grade B coffee beans that I wished that I'm in a forecast transaction to sell to a customer, and let's just call that 100 tons of grade B coffee beans. But in the marketplace, I can only hedge that out with grade A coffee bean derivative. And I can do that by entering into a 100-ton derivative contract. So in terms of the nominal amounts, there are no issues there. However, because it's a proxy hedge, because I can't get a derivative for grade B coffee beans. And I know that there is a difference in the way that grade A and grade B will behave. In order to maximize my hedge effectiveness to the level that I want, I could designate, for instance, 0.8 or 80% of my derivative and say that portion of my derivative instrument is what is in the hedging relationship, and then I match that with 100% of my hedged item. So therefore, that gives a correlation of 1:0.8 as my hedge ratio. Anything that's outside of the hedge ratio relating to the hedging instrument is then treated as just an open derivative and goes into P&L and is recognized as if it's not part of an overall hedging relationship because it's outside of my hedge ratio. Anything that is within my hedge ratio is then accounted for in terms of hedge accounting. So let's say, I got to my ratios of 1:0.8 because I did some back testing, etc., and that's the ratio that's come out at that point in time. So now let's say over the period of my hedge, the market and the relationship between grade A and grade B coffee beans somehow dislocates for whatever reason. And when I now do my testing, I realize in order for my hedge to be effective, I need to change that ratio from 1 to 0.8 to 1 to 0.7. Now that isn't a huge change from where it started off. And I need to make this change in order to keep my hedge effective because it has to be qualitative in line with my risk management practice. So at this point in time, I'm already in my hedging instrument. I can't get out of it. But now I'll designate 70% of my derivative as being in the hedging relationship. And the 30% now goes to be treated as an open derivative with changes going through profit or loss. And 70% of it is part of my hedging relationship. That is what we call rebalancing the hedge ratio. And that might well be sufficient because the response is driven from what we do in our risk function, not what we want to do from an accounting perspective. The accounting follows the risk behavior and not the other way around. Now, it could be that there's a severe dislocation between the correlation of grade A coffee beans and grade B coffee beans, which actually makes the hedge relationship, or in fact the economic relationship, very tenuous, and in fact may now be outside of the boundaries of what we would consider an effective hedge from a risk management practice. We cannot rebalance that. And effectively, that tells us that a hedging relationship must now be discontinued, and in the marketplace, the company must go and respond in some different way. So go and find a better derivative to use if you can't use grade A coffee beans or not. And if they can find that, then they'll create a new hedge from there. But it's not a case of continuously rebalancing the original hedge in order to achieve some kind of mathematical perception of effectiveness. The effectiveness has to be in line with your risk management objectives. On the other hand, it could be that your risk management objective changes. And if your risk management objective changes, you can't fix that by changing your hedge ratio. Effectively, you've now entered into a new hedge, so the old hedge discontinues and the new hedge kicks in. So it's important to understand that rebalancing has its place, and its place is to deal with relatively expected potential changes in the hedge ratio that might occur and might need to be made in order to maintain the overall hedge effectiveness, but it is not there to simply rebalance completely unexpected changes or changes in risk objectives, complete changes in risk objectives. For that, you'd have to discontinue the hedge, and once you've established a new hedge, then designate that new hedge in a hedging relationship. Okay, so folks, just to round off where we are with the new hedging requirements under IFRS 9. So the best way for me to summarize is to say they've kept the primary accounting very similar to IFRS to IAS 39 in the sense that we've got three types of hedges. We still need hedge documentation, etc. What they've really done is that they've tried to align hedge accounting to risk practices. And in order to do that, they've expanded the scenarios under which you could designate something as a hedged item. So hedging of net positions, gross positions, layers, risk components, more risk elements, for example, of non-financial, non-derivative financial items, etc., being designated as hedging instruments and so forth. So it's really been about expanding the scenarios under which hedge accounting can be applied. It's also then making it possible for hedge accounting to persist under more circumstances by removing the 80, 125% bright lines for effectiveness testing, and also by limiting hedge effectiveness assessments to prospective assessments rather than retrospective assessments. We effectively forced companies into quantitative assessment testing rather than potentially looking at qualitative assessments. But most importantly, it's forward-looking, and by and large, simplified and aligned things like the treatment of forward points for time value of money and currency basis points by allowing deferral and other comprehensive income, and then allowing those to be released into profit or loss on a systematic basis, which previously those would have gone directly to profit or loss. So In a nutshell, if you're a current user of hedge accounting under IAS 39, you're going to find it a lot easier to apply hedge accounting under IFRS 9. If you avoided hedge accounting under IAS 39 because you thought it was too rigid or complicated, you're going to prefer IFRS 9 because it's going to make it potentially less complicated, allow the use of more judgment, allow hedge accounting to persist through more market circumstances, including a bit more volatility without being kicked out of hedge accounting, and allows for things like rebalancing of the hedge ratio, etc. So it's going to be much more practical and attractive as a result for you to consider. But I think if I'm really honest, I think a lot of companies that have just shied away from hedge accounting and IAS 39 are quite likely to continue to do that under IFRS 9, which is a pity because it's really not that complicated to apply in a circumstance where you have an active risk management function in a business which is already collecting many of the pieces of information that you need to do the hedge accounting based on. So all I would encourage you to do is, if you've previously written it off as not an option for you, please go and look at IFRS 9 and reconsider whether or not the new rules are sufficiently simpler for you to be able to apply for yourself. Folks, I'm going to remain on the line for the next few minutes to take your questions. So you're more than welcome to type your questions and I will respond to your questions as best as I can. Thank you very much for listening to our webinar, and we'll catch you on the next one if you're not staying for questions.